It is the 8th of May 2023. My name is David Hickson, and in today's market update we're going to be optimistically taking a look at several instruments, starting with the S&P 500 or SPX. Then we're going to take a quick look at the NASDAQ, gold and also Bitcoin. I will be focusing mainly on the S&P 500, where we're going to be delving into the detail of what the cycles are doing in the markets at the moment. So let's start with the S&P 500, and if you haven't taken a look at last week's market update, which I published on Wednesday as opposed to the usual Monday, then I would encourage you to do that before you take a look at this video, because I think it will provide some context. So the big discussion last week, of course, was the 40-day cycle trough, which in the week before I presented various reasons for believing had occurred over here in the middle of April. You can see that on this chart, or at least this analysis of this chart, the 40-day cycle trough has been positioned or phased, as we say, on the 13th of April, which is of course what I was thinking was the situation. In last week's video we discussed the possibility that this could have been the 40-day cycle trough that occurred on the 26th, I think that was, of April. There are various reasons for believing that the 40-day cycle trough might have occurred earlier, which I discussed last week and also the week before. So I would encourage you to go back and take a look at those videos. You can see that now this analysis has positioned the 10-day cycle trough over here at the foot of the chart on the 26th of April. This reveals a very important aspect of a Hurst cycles approach, which is that a Hurst cycles analysis is a constantly developing process. That is simply a fact of life when it comes to performing a Hurst cycles analysis. And if you are going to use Hurst cycles to enhance your trading, to provide you with insight into the markets, it's something that you have to not only accept but understand and work with. And in many ways that was the subject of last week's market update video, where I discussed the fact that it didn't really matter whether the 40-day cycle trough had occurred over here in the middle of April or whether it had occurred a little bit later over here in terms of making sensible trading decisions. What happened last week is that, of course, price came down, formed another trough on Thursday, and then bounced up very strongly on Friday. So what trough was that? Well, looking at the foot of the chart, we can see that we were expecting a 20-day cycle trough at about that time. And so it seems likely that that was the trough of the 20-day cycle. Let's play devil's advocate for a moment and point out the fact that the 80-day cycle whisker. Now this is the circle for the 80-day cycle. The circle represents the exact time at which we would expect the next trough of a particular cycle to form, and the whisker is the line to the left and to the right of that circle, representing the reasonable range of time in which that cycle trough could be expected to form. Now, it is important that we keep an eye on these whiskers, because you can see that this whisker for the 80-day cycle trough tells us that we are within a reasonable range of time in which we could expect this 80-day cycle trough to form. So is it possible that this is in fact the 80-day cycle trough? It is possible, but it is, in my opinion, very unlikely. Let me explain how this kind of situation is resolved when we are working with a Hurst cycles analysis. The first thing that I will do is count the number of bars that have elapsed since the last trough in which we have some confidence, and I certainly have confidence in the 20-week cycle trough that formed in the middle of March. You can see that there were 52 days that had elapsed since that 20-week cycle trough and the trough that formed on last Thursday. 52 days is very early for an 80-day cycle, which has an average length discovered by Hurst, I might point out, 50 years ago, of just over 68 days. So what is the most likely trough that will form at 52 days? Let's write down some average wavelengths here. 68 days is the average wavelength of an 80-day cycle. And at 52 days, we are, of course, 16 days short, which is a very short 80-day cycle. The 40-day cycle has an average wavelength of 34 days, and the 20-day cycle has an average wavelength of 17 days. Now, you will often find troughs forming at about 51 days or 52 days since a fairly prominent trough in the market. And the reason for that is because if you add up a 40-day cycle and a 20-day cycle, you end up with a length of 51 days. And so whenever I see a trough forming at about 51 or 52 days since a trough in which I have some confidence, which is the case that we have on this chart in front of us at the moment, the most likely interpretation is that we are seeing a 40-day cycle plus a 20-day cycle. In other words, we are seeing the formation of a 20-day cycle trough in the markets following the fact that a 40-day cycle has completed, which is exactly the situation that we see on this chart in front of us. There are other ways that we can interrogate this analysis to decide whether it is an 80-day cycle trough, and the simplest of these is to go to the halfway point, which would be 26 days, and ask ourselves whether there was a clear 40-day cycle trough that occurred at that time. Because if we can discover a clear 40-day cycle trough that formed at that time, that would increase the chances that the cycles are running short and that we have experienced an early 80-day cycle trough. Now, I don't really need to draw diagrams on this chart. I think you can see that there isn't a very clear cycle trough that formed at that time. Of course, 26 days occurred over a weekend. There was a potential trough over here at 24 days, but this trough that formed at 31 days was much more likely. One of the reasons why I say it was much more likely is the fact that the 20-day cycle FLD was at the level of price at that time, or I should really say that price was at the level of the FLD, because the FLD is forecast into the future. As you can see, it is simply a line that is projected into the future. And so price came down and found support at the level of that FLD, which increases the odds that this was in fact a 40-day cycle trough as opposed to this trough over here. And so it seems likely that the 20-day cycle trough formed over here last week on Thursday, and that what we are still expecting is for price to come down into the 80-day cycle trough, which we are expecting in about 2 weeks' time. If we take a look at our composite model line, which composes all of the information that we have in the analysis on the chart and puts it together, you can see that we are expecting price to move down into this 80-day cycle trough expected in about 2 weeks' time. So what happened last week? Why did we get such a strong move up on Friday? The reason why there was such a strong move up in terms of cycles is probably because of the fact that the 10-day cycle has increased in amplitude. Now, let me quickly show you how we can identify the amplitude of the individual cycles. We can display something that we call cycle lines at the foot of the chart. These are the cycle lines for the 80-day and the 40-day cycles. You can see they are simple sine wave representations of those cycles in this analysis. To digress for a moment, you will notice that this is, of course, the reason why we experience M shapes on our charts as a result of these cycles. That is because we have two peaks within this period of time. We have a 40-day cycle peak that occurred over here towards the end of March, and another one that occurred at the beginning of May. But because of the combination of the cycles and the fact that the 80-day cycle was reaching up to a peak over here, the combination of those cycles ends up giving us an M shape in this market. And the leg that we are currently experiencing should, of course, be this move down into the 80-day cycle trough. You can see an example of time translation. The 40-day cycle peak does not occur at exactly the time that the peak occurs in the cycle. In price, it is displaced to the right because of the bullish influence of the 80-day cycle. Similarly, the 40-day cycle peak occurs slightly earlier than it occurs in the cycle itself. It occurs slightly earlier in price. This was only very slightly earlier, as you can see, providing us with another reminder that there is still bullishness active in this market. If this market had turned bearish, then we would expect to see much greater time translation, and we would have expected to see a much earlier peak for the 40-day cycle. There are the cycle lines for the 10-day cycle. Now, I should point out that on an end-of-day chart, the cycle lines for a 10-day cycle are a little bit rough. You would probably want to look at your 10-day cycle lines on a 4-hour chart or even an hourly chart. But the interesting thing here is that we can see the diminishing amplitude of that 10-day cycle through the last half of March and into about the middle of May, and you can see that the amplitude of that 10-day cycle has since been increasing. And of course, this move down, then up, then down again, and then up again was largely a result of the amplitude of the 10-day cycle, which you can see has been increasing over here. Now let's take a step back and look at some longer FLDs. This is the 80-day cycle FLD. And considering that we experienced an 18-month cycle trough in the middle of October last year, this is the sequence of interactions that we would expect price to form with the 80-day FLD. Here is the first interaction where price crosses up above the 80-day FLD. I am looking at the 80-day FLD on a weekly chart as a matter of interest, which I've mentioned in previous market update videos is a useful thing to do. You should be careful of looking at an FLD for a cycle that doesn't have a sensible ratio between the cycle length and the length of each one of your bars. So for instance, looking at a 40-week cycle FLD on an end-of-day chart would be a little foolish, because when the FLD provides support, you are going to witness lots of whipsaws, lances above and below the FLD on a daily chart, which is why it's important to make sure that you are looking at the correct resolution chart for each one of your FLDs. That first cross up above the 80-day FLD generated a target an equal distance above the FLD over here, and so that was a target that was achieved, which is of course what we would expect from an A category interaction. Then at around about the time that the 80-day cycle trough forms in the market, we would expect price to find support at the level of the FLD. As I mentioned in previous market update videos where we have taken a look at the 80-day cycle FLD, price didn't find support at the level of the FLD, in which case the B category interaction and the C category interaction, which are usually considered as a pair where price finds support at the level of the FLD, in this case they split into two interactions, and so we get a B category interaction here, which of course would have theoretically generated a target to the downside roundabout over here, a target that was not reached, which is of course what we would expect from a B category interaction where price fails to find support at the level of the FLD. We would at any rate expect price not to reach all the way down to the target. And then, of course, the C category interaction in this case is over here, where price crossed back up above the level of the FLD. In a situation where price finds support at the level of the FLD, we don't get a C category target. But here, because price failed to find support at the level of the FLD, we did indeed generate a target which I believe was met over here by this high price. This over here was the D category interaction where price crossed down below the FLD again, and it again achieved its target, I believe, and that target was over here at the level of the 20-week cycle trough. Then we experienced another price cross up above the FLD, which is the E category interaction. The target from that E category interaction is at a level of, I believe it's about 42.35. I haven't recalculated it today. I think it was 42.35. The important thing is that target has not been reached. Now, is this unexpected? Well, of course, we have a 40-week cycle trough looming ahead of us in the middle of July, and so we are expecting the market to begin to develop some signs of bearishness as price must move down into this 40-week cycle trough. So it is not entirely unexpected that that price has not yet reached their target. It is not yet too late, of course. Price might come up and still reach that target, but the next interaction between price and the 80 80-day FLD is expected to be an F category interaction where price crosses down below the FLD on its way down to the 40-week cycle trough over here, expected in about the middle of July. And so this is definitely an FLD to be watching over the next couple of weeks, because as you can see, price came down and just about touched the FLD last week, then of course bounced up again on Friday, and so far, and I'm recording this video before the markets open in the US, so far we've seen a little bit of overnight activity where price is shying away from that FLD, but we need to be watching that FLD this week to see whether price does succeed in crossing down below it. This sequence of interaction plays out across all FLDs. There are a few tricks when it comes to different harmonic ratios between cycles, such as the 3-to-1 harmonic ratio between an 18-month cycle and a 54-month cycle. That complicates things, but when you have a clean 2-to-1 harmonic ratio between several cycles, you can indeed track the sequence of these interactions. So let's take a look at the 20-week cycle FLD. There it is, and following a trough of at least 18-month magnitude, which I believe the trough in October was, we would have first of all experienced an A category interaction where price crosses up above the FLD. That A category interaction generates a target way up over here at about 4,500. It is fairly obvious that that target has not yet been reached. Usually we would expect that target in a good, healthy, bullish market to be reached before the first 20-week cycle trough forms. However, it is not too late for that target to be reached after the 20-week cycle trough. There are no absolute hard and fast rules about that, but the fact that the target has not been reached is certainly a warning that this market might be about to turn bearish. The next interaction between price and the 20-week FLD was this interaction over here at about the time that the 80-day cycle trough formed in the markets. You can see that the 20-week cycle FLD provided substantial support for price at about this time. In fact, for many weeks, price tracked along that FLD. I think it was 6 weeks that price tracked along that FLD. We would label that a BC category interaction, even though it did not occur at the level of the 20-week FLD, because we do often find examples of double BC category interactions. The more orthodox BC category interaction, of course, occurs at about the time of the 20-week cycle trough, and here again price found support at the level of the 20-week FLD. That would be labeled a BC category interaction. Because price found support at the level of the FLD, we don't separate the B and C category interactions. We label them as a pair, a B and C category pair of interactions where price finds support at the level of the 20-week FLD. It is interesting to note that yet again price tracked along the FLD for a period, I think in this case it was again 6 weeks. The next interaction between price and the 20-week FLD is of course expected to be the D category interaction as price moves down into the nest of lows for the 40-week cycle trough, which of course we are expecting in July. And so we're not watching the 20-week FLD this week or next week, but soon we do need to watch this FLD because we are expecting price to cross down below the FLD on the way to that 40-week cycle trough expected in July. Here is the 40-week cycle FLD. Now, in terms of interpreting the interactions between price and the 40-week cycle FLD, I should point out that this is where we encounter the 3-to-1 harmonic ratio between the 18-month cycle and the 54-month cycle. If this was in fact not only a trough of the 18-month cycle but also a trough of the 54-month cycle, then we would label this interaction over here and this interaction over here as the A category interactions. However, we cannot say with any certainty that the 54-month cycle trough occurred in October of last year, Perhaps I shouldn't say with any certainty, because the idea that the 54-month cycle trough occurred last year is not something that we are looking for certainty in at the moment. It is a vague possibility. If that was not an A category interaction, or if this was not the 54-month cycle trough that formed last year, then this, of course, would be labeled an E category interaction. I'm not going to get too complicated about the 3-to-1 harmonic ratios. It can get a little complicated, but that would have been an E category interaction. The fact that there were two of them like this indicates that we should probably combine these interactions. The 40-week cycle is a cycle that falls in between the weekly chart and the monthly chart in terms of the best resolution. So we're going to continue looking at it on this weekly chart. Here, at the time that the 20-week cycle trough formed, we see price finding support at the level of the 40-week FLD. You will know by now that we will label that as the first of two BC category interactions. I've already discussed the fact that we often experience double BC category interactions. When the 40-week cycle trough forms, we could expect price to find support at the level of the FLD. Why do I say could? Well, we would expect price to find support at the level of the 40-week FLD if this is the BC category interaction, the orthodox BC category interaction. In other words, we would be looking at a double BC category interaction occurring. But for that to happen, we would need this trough to be of greater magnitude than 18 months. I'm going to let you figure that out for yourself, because I've already provided everything that you need, I think, to really understand that. If this was only an 18-month cycle trough that formed in October of last year, then we would not be expecting a BC category interaction, because this interaction over here, or should I say these two interactions combined, would be considered to be an E category interaction, meaning that the next interaction we are expecting would be an F category interaction, where price would be expected to drop down below the 40-week FLD on its way to the next 18-month cycle trough, which of course we are only expecting next year. I hope this discussion hasn't become too complex, but this is going to be an interesting FLD to watch, probably in July, so I'm pointing it out now for us to mark on our calendars to make sure that we are keeping an eye on this FLD. Let's take a quick look at the NASDAQ, and of course the NASDAQ moves with a great deal in common with the S&P 500, so there isn't a huge amount to add in terms of the discussion we've already had with the S&P 500. Here again we have a 20-day cycle nest of lows, and so this low price that formed on Thursday of last week was almost certainly the 20-day cycle trough. Here is the 80-day cycle nest of lows, expected also in about 2 weeks, perhaps just a little bit over 2 weeks from now. As I mentioned in last week's market update, I think it was, the NASDAQ has been more persistently bullish than the S&P 500, so there are of course differences between these markets. The interesting thing here is that on Friday, certainly the peak, the high price on Friday did not exceed the high price on Monday, and so this high price has not been taken out, meaning that at the moment this is still the peak of the current 40-day cycle and also the peak of the 80-day cycle. It is quite possible that that peak is going to be taken out, and so we're going to see some higher prices. There has certainly been a great deal of bullishness, and so calling the 80-day cycle peak now might be a little premature. How would we find the 80-day cycle peak? We can use the other tool that I don't speak about very often in these videos, because the FLD is, in my opinion, the more useful tool, but here is the VTL, and I'm going to take the opportunity to also answer an interesting question from a user of Sentient Trader about this 40-day cycle VTL. You can see that the VTL, and the VTL, the acronym stands for valid trend line. It is simply a trend line that joins two troughs or two peaks, and it obeys various rules. There are only 3 rules, in fact, that Hurst defined many years ago to make it a valid trend line as opposed to just a trend line. And the 40-day VTL, as you can see, joins this trough over here with this trough over here. However, the analysis positions the 40-day cycle trough over here. So surely the 40-day cycle VTL should in fact be drawn like that over there. Yes, now this is a really interesting subtlety about the VTL, and I do apologize, I'm going to get a little bit geekish and a little bit advanced about Hurst cycles at this point in the video. But the interesting thing about plotting a 40-day cycle VTL under this trough over here, which is where it should be according to the rules, is that price crossed down below that trend line. I'm not going to call it a VTL because I'm not sure that it is a VTL, which I'll explain in a moment, but price crossed down below that trend line over here. According to the rules defined by Hurst, when price crosses down below a trend line, it confirms that a peak of the cycle 1 degree greater in magnitude has formed in the market, which would mean that this price over here is the peak of not only the 40-day cycle, but also the 80-day cycle. And yet, within the current 80-day cycle, we have a higher price. In other words, we have a higher peak. This is an interesting anomaly, and it is something that I discovered when I started working with Hurst cycles, is that occasionally when you draw a valid trend line, it is validated because of your analysis at the foot of the chart, you will sometimes get this anomaly where you have the 80-day cycle peak confirmed, and yet you get a higher price. It's an interesting thing, and I'm not going to discuss it at great length in today's video. There are some analysts who believe that, in fact, we should label this as the 80-day cycle peak, and that this peak over here should be considered to be more market noise, as it were. However, I don't entirely agree with that. I think it is possible that because we do still have a debate around the position of this 40-day cycle trough, that in fact the VTL should more correctly be drawn here, because it might be that with the benefit of hindsight in a few weeks' time, we will look back and find that in fact this was the 40-day cycle trough. I don't like making trading decisions on the basis of an analysis that I'm not entirely confident in. And so what Sentient Trader does as a matter of interest is it identifies this anomaly and it draws the 40-day cycle VTL from this trough over here to this other possible cycle trough. Because in this case, we do not have an anomaly in terms of the position of this peak. The reason why this 40-day cycle VTL is really interesting to watch, even if it isn't in fact the truly valid trend line, it's certainly an interesting trend line to watch because, as you can see, price came down to the level of that trend line last Thursday. The reason why it is an interesting trend line to watch is that when price does cross down below this trend line, we will finally be able to confirm the peak of the 80-day cycle is in place. And of course, once that peak is in place, whether it occurred last week Monday or whether price rises up and forms another peak, we don't yet know. But once that peak is in place, then we are going to be watching the market coming down into this 80-day cycle trough. Let's take a quick look at the composite model line for the NASDAQ, which you can see is showing us a greatly reduced move down. In other words, we're not expecting a strong move down into this 80-day cycle trough. That is because the composite model line includes information from the cycle analysis, and it has certainly identified the fact that the bull is still alive and well in the NASDAQ. Let's take a quick look at gold, and this is the analysis we've been tracking for some time in gold, with of course the 18-month cycle peak over here in March of 2022. We have a very prominent and important trough that formed towards the end of last year. That was a trough of 54-month magnitude in my opinion. It could be debated that was an even longer cycle trough, but we won't do that today. Then we had a 20-week cycle trough that formed over here towards the end of February of this year. Now, the peak analysis, as you can see, has become a little bit messy. I'm just going to point out while we're at this zoom scale, this floating 18-month cycle circle. That's always of some concern. What it means is that the peak analysis has not been very clear, and it is possible that this 18-month cycle peak has in fact just formed. Let's zoom in and take a look at a little more detail. If we take a look at the peaks here and the peak analysis, you can see that this 80-day cycle peak was expected according to this analysis. last week sometime. You can see the center of gravity, if you like, of that nest of highs was centered around last week, and so it is very likely that this was a peak of the 80-day cycle that has formed. We haven't had confirmation in terms of price crossing FLDs and VTLs yet, but it seems very likely that that was the 80-day cycle peak. We must pay attention to this whisker for the 18-month cycle, because that whisker, as I've already pointed out, overlaps that peak. So it is just possible that the peak that formed last week is of greater magnitude than 80 days, but it is certainly of at least 80-day magnitude. Now let's take a look at the trough analysis quickly in gold. Here is a very neat nest of lows for the 80-day cycle trough, which you can see was expected sometime either last week or this week. As I have pointed out before, and I often do point out when speaking about gold, the peak analysis is usually more reliable, but it is very useful to keep an eye on the trough analysis as well. So what happened in terms of the trough analysis in gold? You can see that 69 days have elapsed since this 20-week cycle trough at the end of February. The average length, as I've already mentioned in today's video, of an 80-day cycle is 68 days. And so as of today, the 80-day cycle is, according to the average wavelength of the cycle, 1 day overdue. If we take a look at the recent wavelength that the 80-day cycle has been beating at in terms of the trough analysis, you can see that is standing at 72 days. And so it is possible that price is going to come down and form an 80-day cycle trough this week. However, it is much more likely, in my opinion, that this 80-day cycle trough formed last week on Tuesday. Let's just quickly zoom in and consider how troughs form in a market that is more often peak synchronized than is trough synchronized. When a market is trough synchronized, in other words, the troughs occur at the same time, we expect to find sharp, isolated troughs. However, in a market such as gold, which is accepted by most Hurst cycles analysts to be peak synchronized, we expect to find sharp, isolated peaks, and we expect to find rounded and clustered troughs, which means that identifying troughs in gold can be complicated. It's simply because of the way in which the price of gold is influenced by the cycles. And identifying any troughs within this period of 3 or 4 weeks that elapsed over here is fairly challenging, as you can see. If we look at the trough analysis that has been performed, Sentient Trader has identified a 40-day cycle trough below this bar over here, but that's not really a very clear trough. That might be considered a clearer trough over there. Or what about this one? And the 20-day cycle trough has been identified as being over here, and here Sentient Trader has positioned the 20-day cycle trough below the low of this bar over here. The point is that a trough analysis can sometimes be very tricky to perform in a market that is synchronized at its peaks. However, as a general rule, when you are performing a trough analysis on a peak synchronized instrument, when you get a period of consolidation, which is clearly what has been happening over here, you get a kind of a triangle formation, or you get a rounded bowl formation that is forming over there. The most usual position for the peak to actually form is right at the end of that movement, which you can see was over here. Sentient Trader has faced that as a 5-day cycle trough, but in my opinion, it is more likely that the 80-day cycle trough in fact formed over there. The strong move up that we experienced last week was probably price moving from an 80-day cycle trough to an 80-day cycle peak. And the strong move down that we experienced on Thursday and Friday was price reacting to the 80-day cycle peak having formed in the market. The point is that I do not think that we should be holding on to the idea that an 80-day cycle trough still lies ahead of us, even though we do still have the nest of lows on our chart. It is very possible that that 80-day cycle trough has formed, and if that 80-day cycle trough has formed and price moved up into an 80-day cycle peak, then the most recent cycle event is going to carry the most importance. In other words, the peak is going to carry the most importance, and so we would be expecting bearish pressure looking ahead rather than bullish pressure as price bounces out of a late 80-day cycle trough. Finally, let's take a look at Bitcoin, and I've discussed in previous videos about Bitcoin the fact that I believe the 20-week cycle trough formed over here in early March, which positions a very strange 80-day cycle trough over here in the middle of January. I think I discussed that in a previous market update video. Of course, this price action over here was a reaction to the FTX news scandal, and so I don't need to discuss that again. The important thing in terms of our analysis of Bitcoin is that it seems very likely that an 18-month cycle peak has indeed formed in the middle of April. In an earlier market update video, I was speaking about the fact that it was possible that that cycle peak was going to form, and it seems likely now that it has formed. The analysis has clarified a little bit now that Bitcoin has mostly shaken off the results of the news events that occurred towards the end of last year. And so it seems likely that Bitcoin is moving down now into an 80-day cycle trough expected in about 2 weeks' time. Interesting, the correlation between Bitcoin and stock markets around the world at the moment, with both of them expecting a move down into an 80-day cycle trough. Does this mean that I am bearish Bitcoin? Well, it depends on your time frame. I should point out again that we did experience a very important trough towards the end of last year, and so to call me bearish in terms of Bitcoin would certainly be a mistake. There is that very big trough that formed, in my opinion, in November of last year. That was a trough of at least 54-month magnitude. And so as we have a 54-month cycle trough behind us, the bigger picture, the longer-term picture is certainly that we are still bullish Bitcoin. I do hope you found this market update useful and interesting. If you have any questions, please join us on our Discord server. And of course, you are very welcome to ask your questions in the comments below this video. I look forward to hearing from you.